Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. Let's begin then on the bond market, which is a huge theme at the moment. The bond yields are driving capital markets, equities included. They start off by saying this is all from MRB. As MRB expected, the US economy has defied bearish consensus forecasts for a recession this year. And inflation has been stickier than the Fed and most economists were forecasting. We remain bearish on bonds. Let's look at the real interest rate. That is rising significantly. And what do they have to say about the shape of the yield curve? That sends very useful clues for the outlook in the equity market, the timing of the equity market cycles. It's quite good to take the cue from the bond markets. Bond markets have much deeper liquidity. They tend to have much more efficient pricing as a result of that. So what happens in the bond market often only occurs in the equity market weeks or even months later. So equity bulls beware. The next sustained curve steepening, the steepening of the bond yield curve, will only occur against a backdrop of an economic and earnings recession. So what do they mean by the sustained curve steepening? It means that short rates will be falling. In other words, don't expect the Fed to cut rates until we have a proof of an economic and earnings recession. Only after the economic downturn develops will a shift to an equity overweight within a multi-asset portfolio be appropriate. The risk of a recession will increase if bond yields continue to climb as we expect. The key risks: a pronounced further rise in treasury yields or other shocks, such as a sharp rise in oil or energy prices, or a cascading fallout from global economic weak links. I'm going to be talking more about these weak links in a short moment. The investment strategy over the next 6 to 12 months hinges largely on the trajectory of bond yields. So turning to the weak links, will higher bond yields break the global economy? Not in the US or in the euro area. In those regions, households have become much more resilient to higher interest rates than was the case in the 2010s. Recessionary tendencies are likely to first emerge outside the US and the euro area. Recessionary forces will first develop because of a fallout in the weak links, rather than being led by retrenchment in US and euro area consumers. Investors need to monitor these weak links closely. So what is the definition of a weak link? These are typically segments of an economy, or maybe even a whole economy, that have greater imbalances and or leverage than others, making them more vulnerable to rising interest rates. We have termed these economic weak links. When weak links snap, it causes contagion to spill over into healthier sectors of an economy. Well, first of all, let's identify what they are so that we can monitor them. First of all, global commercial real estate and the US regional banks. Commercial real estate is supported by significant borrowing and could result in meaningful contagion for US regional banks, which have outsized exposure to these assets. Another weak link, non-financial corporate debt. Some parts of this sector will now be vulnerable when they need to refinance their debt obligations at much higher borrowing rates. And then finally, the old chestnut that we've been talking about for some time, economies with household imbalances and housing bubbles that were inflated throughout the 2010s. These include the UK, Canada, Australia, Sweden. They now have a housing affordability crisis due to both sky-high home prices and the surge in mortgage rates. An even larger concern is the household debt bubbles underpinning home prices. So let's keep a lookout for those weak links. We're moving on now to Alpine macro, global asset allocation. The US economy has been sustained by fiscal thrust and stronger than expected consumer spending and capital investment. These tailwinds are poised to fade as we go into the end of the year in 2024. Short-dated fixed income now offers improved risk-adjusted value, and that is what we will be adding to the balanced portfolios with the cash, or at least a large part of the cash that has become available in the last couple of months from the exit of various investment companies in the portfolios. The US dollar will remain well bid as long as the Fed stays hawkish and geopolitical tail risks lurk. And if we look at money and credit growth, particularly M2, it's plunging. It's been positive anywhere between about 7% and 28% just after the pandemic. That's real growth in percentage terms, year-on-year percentage terms, all the way back to 95. I read somewhere that M2 is declining at the fastest rate in the US since the 1930s. And sure enough, if that happens, the economy will definitely slow down. Moreover, a rise in the price of oil, the value of the US dollar, and long-dated interest rates since the summer constitute an additional growth tax, forcing the slowdown. It's good for inflation, of course, and eventually that means that the Federal Reserve will begin cutting interest rates, and that will be good for the markets in 2024 and 2025. But we probably need to wait until there is firm proof of that slowdown before we go to the races again. War in the Middle East raises the prospect of an oil shock in the event of an escalation in the war between Israel and Hamas beyond Gaza. Global oil production discipline and low reserves put a floor under oil prices, even amid the prospect of weaker cyclical demand. The risk of a surge in oil prices keeping inflation up will sustain a hawkish Fed. There's just one last item here on the US dollar. I think it's quite important. Where will the dollar go? Persistently hawkish Fed policy combined with a relapse in China's economic recovery momentum have supported the dollar in recent months. A dovish Fed pivot or a stronger Chinese growth are prerequisites for a weaker dollar. That's what we'll have next year. It'll be very good for boosting global liquidity. The dollar is a contra-cyclical currency, so it tends to weaken when risk assets are doing well. It tends to strengthen when they're doing badly. It tends to lead those risk assets. So if the dollar weakens, those risk assets will do incredibly well. But that's not just around the corner. It'll be next year. So let's look now at the Israel-Hamas war, the market implications, scenarios, risks, implications, and this is research from Alpine Macro. The key question is how widely the conflict will spread and if it would impact global markets. There is also a question of duration. Based on previous conflicts involving Israel, we estimate that the current conflict will likely last less than 3 months. So they've got three main scenarios. The baseline scenario, to which they ascribe a 70% probability, and I must admit, if you look at the signpost, it's looking increasingly likely. There's a section on it in the weekly market report. Of the three scenarios, the most likely one, scenario one, the Gaza Strip war will be limited regional escalation, 70% probability. Most Arab states support the Palestinian cause, but do not want an expanded war, or for that matter, even a victory for Hamas, Hezbollah, and Iran. The Palestinian Authority, Hamas's political rival, which governs the West Bank, has also openly criticized Hamas's aggression. In this scenario, the conflict is likely to stay largely within the Gaza Strip, with only limited skirmishes in Lebanon, Syria, and the West Bank. The primarily Gaza-focused conflict should be globally market neutral. And then a major regional war, a 30% chance. So this report was written about a week ago, and since then the 70% scenario probably has increased to 80%, major regional war down to 25 or 20%. Far worse, Israel targets Iran's nuclear program. Israel's long-standing and main strategic goal is to end Iran's nuclear ambitions, and a regional war would be an opportune moment. Israel's time window to act against Iran is likely narrowing, especially as Iran is procuring advanced Russian fighter jets. Lastly, bullish comment from Capital Economics, and this is what they have to say. Although we have revised up our forecast for the 10-year Treasury yield between now and the end of 2025, we aren't inclined to change our upbeat projection for the S&P 500 over this period.
Thank you, Nick. Thanks again for a very interesting and wide-ranging and comprehensive macro overview. Locally, it's rather quiet. I think the action will start next week. But company news, we own Reinet. The Reinet reported net asset value per share in euros of 32.79 euros. That was at the end of September. That is virtually the same as the end of June. There was a little dip of 0.6%. Anglo American, we own Anglo American. They reported production figures for the September quarter. These figures are year on year, is comparing September 2023, that quarter, with the quarter of 2022. There was a 42% rise in copper production, all of it in Chile and Peru. And the reason for that is a big new mine that came into production in Chile. And there's a 4% rise in manganese production. And unfortunately, there was a lot of declines. Nickel declined to 7%. That's from operations in Brazil only. Diamonds declined was 23%. And we have already seen that De Beers is selling less diamonds at their auctions. Steel-making coal, that drop was 21%. Platinum was flat. And the platinum from Anglo American dropped only by 2%. And iron ore was down 4%, mainly because of plant maintenance and issues with Transnet. And then more macro news, the Deputy Governor of the Reserve Bank, Gilbert Naidu, has resigned. Newspapers refer to him as a dovish governor. He was an experienced and good Deputy Governor, and he will be grabbed up by one of the big banks. Then the mini budget, that's on Wednesday next week. It's a medium-term budget policy statement. We're looking forward to that. And we also have got a new public protector. She was appointed last week. It's Advocate Gielie. There's also next week big forum in Johannesburg. It's a AGOA forum. AGOA stands for the African Growth and Opportunity Act of the USA. South Africa is part of AGOA, but we could be kicked out. AGOA is an American forum to assist African countries.